March 2023, Silicon Valley Bank collapsed in 48 hours. Overnight, depositors were locked out of $175 billion. Meanwhile, inflation has stolen 20% of the dollar's purchasing power since 2020. The harsh truth? Your bank account isn't safe. It's a slow-motion financial trap. Today, I'll reveal 7 strategic assets that protect your wealth better than any savings account, backed by data, history, and what billionaires are quietly doing right now. The problem. The FDIC insures your deposits up to $250,000, but during the 2008 crisis, it took years for some to recover funds. Today, with banks paying 0.01% interest while inflation runs at 2.8%, you're losing 2.79% annually just by leaving cash idle. Worse, as we saw with SVB, even too big to fail institutions can vanish overnight. Let's fix that. Asset 1. Treasury Bonds, 4.3% yield, 0 risk. The 10-year Treasury now yields 4.3%, triple the average savings account. But the real advantage? During the 2008 crisis, while stocks crashed 50%, long-term Treasuries surged 30%. Why? They're the ultimate flight to safety asset. Buy them directly via treasurydirect.gov, no bank middleman. Key stat. Since 1928, long-term treasuries have never had a negative 20-year period. Asset 2. Cash-flowing real estate, the inflation hedge. Commercial real estate is in turmoil, but multifamily housing in Sunbelt cities like Austin and Tampa still delivers 6 to 8% cap rates. REITs like INVH, single-family rentals, or AMT, cell towers, let you invest without being a landlord. Remember, rent checks don't stop when markets crash. Pro tip. Use a self-directed IRA to buy real estate tax-free. Asset 3. Gold, the 5,000-year store of value. Central banks bought 1,136 tons of gold in 2023, a 60-year record. Why? Because when the dollar weakens, gold thrives. Since 1971, it's outperformed the S&P 500 by 201 during inflation spikes. Physical gold, coins, bars is best, but ETFs like GLDM offer low-cost exposure. Critical insight. Gold isn't for growth, it's for survival. It preserved wealth through Weimar hyperinflation, the 2008 crisis, and COVID. Asset 4. Collectibles, the passion economy wealth hack. A 1970 Rolex Daytona Paul Newman sold for $17s. $8 million in 2017, a 89,000x return. But you don't need millions. Rare trading cards, vintage watches, and even Lego sets have outperformed the SP. Platforms like Rally let you buy fractional shares in blue-chip collectibles. Warning, only invest in what you understand. Liquidity is low and fakes abound. Asset 5. Physical cash, the Black Swan insurance. During Greece's 2015 bank holiday, ATM withdrawals were capped at 60-day. Smart investors kept 3 to 6 months' expenses in a fireproof safe. Not for investing, for emergencies when the digital system fails. Rule. Cash is trash long-term, but king in a crisis. Asset 6. Your business, the ultimate wealth machine. Amazon started in a garage. Today, small businesses generate 44% of US GDP. Even a side hustle, like a $5,000 month local service business, compounds faster than bank interest. Tools like Shopify and ConvertKit make it easier than ever. Mindset shift. Stop saving dollars. Build systems that print them. Asset 7. Bitcoin, the digital gold experiment. Yes, it's volatile. But since 2010, Bitcoin's annualized return is 160%, versus 8% for the SP. BlackRock's ETF IBIT holds $18 billion, and nation-states like El Salvador own it as reserves. It's a speculative hedge, but as Michael Saylor says, in a world of infinite money printing, scarcity has value. Strategy. Allocate 1.5% as a lottery ticket on monetary system change. Closing challenge. The biggest risk isn't market volatility, it's doing nothing. Pick one asset to research today. Drop a comment. Which of these will you explore first? I'll reply with a resource to get started. P.S. For a free guide on building a crisis-proof portfolio, click the link below.